When I was younger, I thought complexity meant being clever. I thought doing more research, more mixing of assets, more adjusting meant getting better results. So I kept adding layer upon layer, more stocks, more methods, more reasons to constantly tweak and modify and second-guess every choice. Every single thing I did to try and improve my investment pot actually destroyed value. It totally wiped it out. The truth about compounding is that it works both ways. You build wealth forward by staying still. You build losses backward by constantly changing things. And I learned this lesson the difficult way by making every mistake possible, not just once, but many times. I kept making the same errors repeatedly before I finally understood. Most people think creating passive income requires great intelligence, some special ability to pick stocks that no one else has. That's backward thinking. Most people think you need a complicated plan to outperform the market, also backward. Most people think more is better, more income sources, more research, more investments, more adjusting for the best result. That's how they guarantee themselves a life of average returns and stress. Simple passive income is this. Build your capital to $300,000 to $500,000. Put it into 3 to 5 excellent dividend-paying companies. Never touch it. $300,000 at 4% interest gives you $12,000 in passive income per year. $500,000 at 4% gives you $20,000 per year. That's serious money. That's enough to live on without having to work, but it demands patience. Patience most people simply do not possess. 95% of people never achieve this because they're addicted to complexity. They cannot stay still. Every month, every week, they're researching something new, optimizing something, rebalancing something, trying to catch something they feel they are missing. Every hour they spend doing this costs them compounding time, real time, time they won't get back. Let me be clear about the numbers here. If you spend an extra 100 hours per year researching and rebalancing your portfolio, what do you really gain? Maybe 1% extra return in a good year, maybe nothing in a bad year. But that 100 hours multiplied by 30 years equals 3,000 hours of your life. 3,000 hours for maybe an extra $300 per year. It's completely nonsensical. It's mathematically absurd. Here's what stops most people before they even begin. 5 obstacles. 5 predictable mathematical hurdles that prevent the vast majority of people from ever building simple passive income. I've watched people make these errors for 60 years. I've made several myself. And the cost isn't just money. It's decades of your life spent pursuing something that was easy all along. The first obstacle is chasing yield over safety. It seems logical. You want more income, so you reach for higher returns. 8%, 10%, 12% yields instead of 3%, 4%, 5% boring yields. But high yield is a trap. A beautiful trap, but a trap nonetheless. Here's why it ruins passive income. First, yield relates to risk. When a dividend yield goes above 6%, the market is communicating something to you. It's telling you that investors are worried. They're demanding extra return because the stock is riskier. The danger comes when you pursue it anyway. You tell yourself the yield is so attractive that the risk is worth it, but it's never worth it. It never is. The market isn't giving you that extra yield because it's being generous. It's giving it to you as payment for the risk you are undertaking. Second, when returns are cut, and they always are cut during difficult economic times, your entire portfolio collapses. I saw this in 2008. Banks were giving 8% to 10% returns. Everyone rushed in thinking they'd found a secret. Dinu Rules and REITs dealt with increasing interest rates. He'd lost $60,000. His portfolio was down to $140,000. He was now 57, not 55, and he'd lost 30% of his wealth simply for chasing an extra 2% to 3% in yield. He lost what took him 20 years to build in just a few years. He told me later, "I spent more time researching those high-yield funds than I would have earned in extra returns, and then I lost it all." That's chasing yield over safety. It always ends the same way. The lesson is simple. Safety comes first. Yield is a bonus, not the main objective. If you want higher passive income, you build your size first. You don't chase yield, you don't reach for return, you reach for safety and let time do the work. Now, chasing yield feels risky and emotional. The next obstacle is even worse because it feels safe and smart. It's diversification addiction. Most people think spreading investments around is the solution to everything. They think 50 different stocks equals 50 times the safety. 50 different ETFs equals the best possible protection. That's completely wrong. More positions don't mean more safety, they mean more ignorance. Here's the truth. Warren Buffett doesn't own 50% dividend stocks. He owns 5%, actually even fewer. Berkshire Hathaway owns roughly 60% of its portfolio in just 3 companies. Wesco Financial, which I managed for decades, was 95% concentrated in 3 positions. That's not being reckless, that's mathematics. When you genuinely know what you're doing, concentration beats diversification every single time. But when you are uninformed about markets, when you don't truly understand the businesses you own, then what do? You buy everything, 50 stocks, 12 exchange-traded funds, ETFs, some bonds, some alternative investments, hoping that somewhere in that heap of average investments something will perform well. You're not diversifying, you're hedging your ignorance. You're protecting yourself from the embarrassment of admitting you don't know what you're doing, and worse, too much diversification ruins your returns. You own so many investments that your portfolio simply mirrors the overall market. You get market returns, 7% to 8%. With all the effort of managing your investments actively, it's the worst possible outcome. You're working hard but getting average results. I knew a man named Richard. He was a financial advisor in Los Angeles, 62 years old in 2005. He had a concentrated portfolio, 5 main dividend stocks that had been growing beautifully for decades. His returns were averaging 11% annually. 11%, not 8%, not 9%, 11%. But he started reading books about modern investment theories. He started attending workshops about the right way to spread assets. He started thinking he needed to be properly diversified. He thought 5 stocks was dangerous. So he expanded his portfolio from 5 stocks to 47 stocks across 12 different ETFs. He added bonds. He added alternative investments. He included international exposure. He added small company value stocks. He added large company growth stocks. He had everything. His task of monitoring exploded. He was spending 40, 50 hours a month checking investments, reading research, trying to adjust everything perfectly. His returns dropped to 7.2%. Every single year, he was losing 3.8% in potential returns on a $300,000 portfolio. That's $11,400 per year. Over 10 years, that's $114,000 lost to excessive diversification. Over 30 years, that's approaching $1 million in lost opportunity. He's now 67. He still checks his portfolio constantly. He regrets every single day that he ever diversified away from his core 5 positions. He recently told me, "I thought 47 investments were safer. They just made me stupider." The lesson: concentrate, don't diversify Beck. Tee it completely alone. By 2023, 15 years later, that $250,000 had become $480,000. An annual return of about 4.2% compounded over 15 years. Simply boring, mathematical, just dividends, reinvesting, and a little bit of growth in the stock price. But David got anxious during the market downturns in 2011. When the market fell 15%, he panicked. He called his advisor. He got scared. He thought the market was going to crash all the way down to zero. So he sold everything. The portfolio was down to $230,000. He was sitting in cash, feeling safe, but also angry at himself. Then in 2012, the market started recovering. Instead of feeling relieved, he got FOMO, fear of missing out. He thought he'd missed something. He thought everyone else was making money while he sat in cash. So he bought back in, but of course he bought back in after the market had already recovered. He bought at higher prices than he'd sold. He repeated this pattern 3 times over those 15 years. Sell low, buy high, sell low, buy high, sell low, buy high. The worst possible sequence. His final portfolio value in 2023 was $420,000. Same market, same stock, same timeline. But his action cost him $60,000. His taxes on realized gains cost another $12,000. $8,000 in trading fees. Total damage $80,000 in lost potential from action bias alone. $80,000 gone because he couldn't sit still. He told me every time I thought I was being smart, I was actually being stupid. I should have just sat still. The lesson. The best action is often inaction. We're rewarded for discipline and patience, not for activity. Your portfolio doesn't need you. Leave it alone. Stop looking at it. Stop reading articles about it. Stop trying to improve it. Just leave it alone. Now, action bias is clear when you see it, but people hide their action bias behind something that looks intelligent. They call it strategy, complex strategy that seeds LD do better. He had spent his whole career in investment management. He couldn't just leave his portfolio alone. He created what he called a proprietary blended strategy. He hired himself as his own advisor. Over the next 18 years, he charged himself 1.5% annually in advisory fees, money he was paying to himself to manage his own strategy. 1.5% per year on $200,000. That's $3,000 per year. $30,000 over 10 years just gone. His strategy changed 2 to 3 times per year as market conditions shifted. When the Federal Reserve was raising rates, he'd shift to different sectors. When inflation was high, he'd shift again. When worries about a recession grew, he'd shift again. He was constantly tinkering, constantly optimizing, constantly paying himself to manage the complexity. In 2005, when his father's portfolio started at $200,000, Robert started at $200,000 as well. By 2023, his father's boring 3-stock portfolio had become $350,000. Simple 4% compounding, no fees, no complexity, no stress, $350,000. Robert's portfolio, after 18 years of his proprietary blended strategy and 1.5% annual fees, was $290,000. Same market, same companies, same time frame. His strategy underperformed by $60,000 plus fees charged to himself of $27,000. Total cost of strategy theater, $87,000. He told me recently, and I love this, I charged myself 1.5% to underperform my father's stupid strategy. That's not investing. That's ego theater, the lesson. Strategy complexity is the enemy of compounding. The simpler your approach, the better you'll do. Warren and I haven't had a new investment idea in decades. We have a process. The process is find obviously great businesses at reasonable prices. Buy them, hold them forever. That's the strategy. Everything else is theater. But here's the real problem. Even if your strategy is right, even if you have the discipline to stick with it, there's one more obstacle that stops most people before they even start. It's not even about investment skill. It's about timing. It's about impatience at the start. It's about starting with not enough money. The 5th obstacle is impatience at entry. Most people want passive income now. They want it immediately. They want to retire at 35. They want $20,000 in passive income before they're 40. So they start with whatever they have, usually not enough. And then they get impatient when 4% growth isn't creating major lifestyle changes fast enough. Here's the math. $200,000 at 4% equals $8,000 per year. You still need a job. You still can't retire. But $500,000 at 4% equals $20,000 per year. That's sustainable. That's real passive income. That's freedom. That's more than double. The gap between $200,000 and $500,000 is massive. It's a 10 to 15 year gap if you're saving aggressively and getting 4% returns. 10 to 15 years of discipline, 10 to 15 years of boring saving and investing and compounding. But people can't wait. They want passive income at 35, and they want it now, not in 10 years. So they get impatient. They take their $200,000 into crypto or high-risk trading or leverage strategies, thinking they'll speed up the process, thinking they'll turn it into $500,000 in 3 to 5 years instead of 10. They think they can squeeze a decade of wealth building into a few years. It never works. Never. Not once. The math doesn't allow it. I knew a man named James. He was a sales manager in Austin, Texas, 35 years old. He had saved $120,000 through his salary and discipline. He was on track to reach $500,000 by age 45, giving him $20,000 in passive income by middle age. Not bad, not amazing, but solid. But he got impatient. He wanted passive income at 35, not 45. He wanted to retire right then. So he moved his $120,000 into crypto and microcap trading. He thought he'd figured out the secret. He thought he could grow his money at 20%, 30%, 40% annually instead of 4%. In 2020, during the market boom, he got lucky. He was up to $340,000. He thought he'd figured it out. He thought he was a genius. He was on track to reach $500,000 by 37 instead of 45. He was going to retire early. He was going to write a book about it. Then 2022 happened. His portfolio crashed to $160,000. He had a margin call, a demand to put up more money. He had to sell at the worst possible time. All his gains from 2020 were wiped out. He lost $180,000 in 6 months. Now he's 37 years old with $160,000 and no longer believes passive income is possible. Actually, it's still possible. He just set himself back 7 years. He still needs to reach $500,000, but now he's starting from $160,000 instead of $120,000. At 4% return in salary savings, he won't reach $500,000 until age 50 or 52 instead of 45. Impatience at entry cost him 7 years and probably $700,000 in lifetime passive income. For what? To try to squeeze 10 years of wealth building into 3. The lesson: patience at entry beats speed of returns. It's better to start small, build to a sufficient size through steady saving, and then grow boring yields for 30 years. That's how you get passive income for life. Not in 5 years, in 15 to 20 years. Start now. Be patient. Wait. So these are the 5 obstacles. All of them come from one root cause. People want results before they understand the game. They're impatient at the start, so they overcomplicate, over-diversify, overact, and chase yield, all to compress a 10 to 15-year wealth-building process into 3 to 5 years. And it never works. It never works. But I didn't learn this from textbooks. I learned it the hard way in 1952. I was a lawyer in Los Angeles making good money. Very good money for that time. I had colleagues earning the same income, but I made a choice they thought was insane. I lived below my means. Not a fancy apartment in Beverly Hills, a simple place, not a new car, an older one. While they were improving their houses and buying second homes and taking expensive trips, I was saving every dollar I could. I was building capital while they were building up their spending. I was boring while they were living it up. By the time I was 35 years old, I had accumulated capital that most lawyers who'd been earning the same income their whole careers had never even come close to. By the time I was 40, when I partnered with Warren, I had real capital, real compounding power. I had the foundation for everything that came after. That decision to live simply, to delay gratification, to compound capital instead of lifestyle, it was the foundation for everything. The lesson was clear then, and it's clear now. Every dollar spent on lifestyle increases, every hour spent adjusting, every year spent chasing yield, all of it is just noise. Simple patience builds wealth. Everything else is performance. Everything else is a distraction. And that's why I have these rules. Rule 1, avoid complexity. If you're pursuing complexity, you're pursuing regret. Build to size first. Simple dividend payers, boring concentration, predictable results. Complexity is the enemy of compounding. Rule 2, patience beats speed. If you want passive income, you don't speed up the process, you slow it down. Work 15 more years to $500,000. Then let 3% to 4% grow for 30 years. That's how you get $20,000 to $30,000 in passive income for life. Not in 5 years, in 15 to 30 years. Rule 3, concentrate on the obvious. If you can't understand it in 30 seconds, you don't own it. If you own more than 5 to 7 main investments, you're holding junk. Concentration I. Now, let me connect this all together because there's a simple formula here and it explains everything. Simple size plus boring yield plus forever patience equal to passive income for life. That's it. Not 5 complicated steps, not a blended strategy, not an advisor churning your portfolio, not complex safeguards or exotic methods, not cryptocurrency, not borrowing money to invest, not any of that. 3 to 5 dividend aristocrats, 3% to 5% annual yields never sell. That's it. That's the entire formula. That's everything. $300,000 becomes $800,000 over 30 years. $12,000 in passive income becomes $32,000. It's not attention grabbing, it's not thrilling, it's not going to make you rich overnight, but it's the only thing that actually works. It's the only thing that reliably, mathematically, without question, builds wealth. The formula is so simple it feels almost insulting, which is exactly why most people reject it. They want it to be complicated, they want it to require genius, they want it to require special knowledge. Complexity feels smarter. It feels like you're doing something sophisticated. But smart is dull. Dull is what works. Dull is what wins. I've lived 99 years. I've seen 18 periods of economic difficulty. I've made billions by being dull, concentrated, and patient. And here's what I'd tell you if you gave me one more minute of your time. The window to build simple passive income closes quickly. Every year past 50 that you're still looking for complicated solutions, chasing high returns, or changing your strategy is a year you'll never get back. You're either going to do the boring, simple thing and win, or you're going to pursue complexity and lose. That's the only real choice here. So choose now. What's it going to be?